Okay, so good morning, everyone. Welcome to this webinar from K. Johnson G and our partners Capitalise. We have used and been a partner of Capitalise for a long time now, and have found that they have been an extremely useful way of us sourcing funding for clients. We were not sure as we got into that relationship how it would pan out because it was a new relationship. But I can say, not just because they're listening to me and it's their webinar with us this morning, but I can honestly say that the platform itself, and more importantly, the people behind it who you deal with, are not only helpful but extremely knowledgeable about their subject matter, and it's been a very good relationship as far as K. Johnson G are concerned. So, and we've successfully used it for clients. So I'll pass you over to the experts, as it were, Kip and Rory, and I think Rory's up first to get us underway.
I think you might be on mute, Rory.
Good start. Good morning, everyone. I'm Rory. I'm one of the partnership managers here at Capitalise. I'm joined by Kip, who's our head of vendor relations. If you could go to the next slide, Kip, for the agenda, please. So, Stephen, thanks for that introduction. So, agenda for today, I'll cover off who Capitalise are, and then Kip's going to do a bit of a deep dive into CBILS, give you an update on the options available currently, and then he's going to go specifically into property finance, invoice finance, corporate finance, and then I'm going to talk to you a little bit about business recovery, and at the end, Stephen and I will help with some Q&A, but do feel free to put questions in the chat box as we go along, and we'll try to answer them as we go through. So Capitalise an advisor-led platform, and by working with your accountant together with Capitalise, we'll be able to unlock over 100 different financial providers. Importantly, by going through Stephen and the team at K. Johnson G, you'll be 4 times more likely to get the right funding at the right time and at the right price. Very important at the moment because we've got a fluid funding marketplace. Things are changing weekly, so we'll be able to help you find the best solution together with K. Johnson G. Over to you, Kit.
Yeah, thanks very much, Rory. So what I'm going to do is just give a bit of background and context to sort of CBILS, bounce back loans, the changes that have been announced. I mean, it's been a lot of changes, which I'm sure we're all quite aware of in the last few days, which are going to affect us quite deeply moving forward. So it's just providing a bit of context and a bit of sort of an overview of what we've been through, because whilst it may seem like a lifetime since we were in sort of, coin normal terms, it's actually only been 7 months since the original lockdown. So it's good sometimes just to take a breath and a bit of an overview and just look through what we've been over. So we'll start with this slide. So this is just having a look and providing, like I say, that context to where we are. So if we look back to sort of January, February this year, we had a very, very open, highly competitive commercial lending landscape. There were over 365 active lenders. New ones were coming on all the time. Sort of quite innovative products were coming through in the marketplace. We were finding more and more clients who potentially were slightly adverse to normal lending or had only ever really gone to their banks, high streets. They were able to obtain finance and, really boost and help their actual businesses come through. Clearly, as we're all very, very aware, on the 16th of March, lockdown hit, and that had a monumental effect on the entire landscape and everyone's business moving forward. I don't think there's a single sector which hasn't been impacted either in a negative or potentially positive way through what's obviously happened with COVID. So what happened in the lending landscape come the 16th of March is a lot of lenders paused in terms of what they were doing. Lenders don't like uncertainty. It makes it very difficult for them to sort of price risk and actually adequately lend to the marketplace. So what they did was a lot of them retrenched. They sort of stopped their lending. They looked after their own back book, ensuring there weren't high default rates and various other things. And it was at sort of that point when the government realized, and they're well aware of what happens with uncertainty with lenders, they had to come in and provide schemes and support to sort of enable that landscape and that lending marketplace to still provide the real necessary liquidity into the marketplace, especially in a time when it's most needed. It's one of these classic cases of lenders are willing to lend in the good times. They're much less likely to lend in the bad times. And that's when the government support came in. So initially we had CBILS that was first opened up into the marketplace. That was also on the actual 16th of March, so the date of the lockdown. Now, if we sort of remember back then, CBILS was actually just a replica of what used to be the enterprise finance scheme beforehand. So it was only open to some existing high street banks and what are called LEPs, local enterprise partnerships. So we're talking about the sort of historic dinosaurs of the lending landscape, and having worked from Lloyd's, I know it all too well. So they were asked to come up with a brand new process, a brand new set of requirements, and start lending to businesses who were sort of, quite honestly, in panic mode. And it's understandable when you've been asked to completely shut your business and you've got no timescales and ideas of when it's going to reopen or how it's going to affect things. So there was vast amounts of applications coming through for CBILS at a time where the banks weren't even really ready to process them. So we had a huge sort of issue with just a massive amount of demand and just very little supply and liquidity coming from these high street banks. And it took actually nearly 8 weeks before another lender came into that CBILS marketplace. However, since it has changed and evolved, and I will go onto that in a bit more detail, but clearly it didn't provide what was needed straight away. So that is when the bounce back loans came into play, and that really has dramatically changed everything. There's been, I think it's now nearly £40 billion worth of lending from bounce back loans, and that is an astronomical sum of money that's been provided into the marketplace at a time when it's really, really needed. But again, it's only up to 50,000, and it probably isn't enough for most businesses. So it's important, again, and we'll talk about it in the next slide, that we look at potentially, is that enough, especially now? But clearly there've been a huge range of schemes. I mean, when I first did this slide, there are only a couple of points, and it's just been added to as new things come out. So clearly we've had grants, business rate relief, HMRC deferments. We've had the furlough scheme, which we had announced yesterday, I think it was, which has now been extended again for November as we enter the second period of lockdown. Again, with the self-employed income support, that has again been extended. We had the Eat Out to Help Out. We've had VAT reductions in the hospitality sector to 5%. We've had no VAT on property up to 500,000. We've now got a new grant scheme up to 3,000, I believe it is, for November. We've had a debt freeze in terms of on credit cards, personal loans. You can apply for repayment holidays. The mortgage repayment holiday scheme again has been extended to up to 6 months for those who need it, and that bit of support. So there's a huge array of different government support. So it's really, really important that you ensure you look at these. These are the easiest and the free money that you can get that is really out there that you need the support with. So if you are interested in those things, clearly speak to K Johnson G, and they will obviously advise you on what is best for your business and personal circumstances. So that's sort of the time frame in terms of where that's been. Now, the lending landscape during that period has again changed really quite dramatically. Like I said, unless you were realistically on that CBILS and bounce back loan schemes through the British Business Bank, most lenders weren't very active in the marketplace. Like I say, just because of that uncertainty, they need to understand where the economy was moving to, how the landscape was going to evolve, so that they could actually accurately lend and provide the debt they needed to. Realistically, it was probably about August time that most lenders started sort of re-emerging into that market. And since then, the majority are now actually back and active, albeit at different stages in terms of, sectors they're willing to support, potentially lower loan to values and things, which will go on in a bit. But I think it's important in terms of the confidence moving forward that we realize that the lending landscape it's not going to go back to where it was in terms of it virtually stopping in March like it really did, because we understand the impact of COVID. We understand what the support schemes in place. We understand CBILS, bounce back loans, everything much more. Lenders are more active. And that's from me speaking to nearly all the lenders on a weekly basis. We're very, very confident that none of them are just going to suddenly pause or stop their lending. We certainly haven't heard that. So there is a lot more confidence, and sort of, whilst it's not great certainty, there is more certainty in the marketplace. So hopefully that gives you a good sort of overview and picture of where we are in terms of the lending landscape and all the other sort of government support schemes and policies that have been put in place. But there will probably be more announcements on Wednesday after the lockdown is ratified. Usually Rishi does come up with a few points, so I'd highly recommend having a look at Wednesday and seeing what else is out there. So in terms of then the products, clearly CBILS was the first one to come into the marketplace. Like I say, it's evolved from just the high street lenders into now 100+ lenders across the full range. So it varies from 50,000 up to 5 million, no PG up to 250,000. You can have it multiple times across multiple lenders across the full range of products. So CBILS is active in term loans, it's active in invoice finance, asset finance, and secured. So you can have it across the entire products, and you can have multiple loans up to 250,000 across multiple lenders. So it's a brilliant, unique product, which is really designed to just help businesses get as much liquidity into the marketplace as you need. And it really, really is a win-win. There's no cost whatsoever to the business for the first 12 months. So I'd highly recommend those businesses potentially who have looked to their high street banks and potentially been rejected or not got enough, because high street lenders will always have the strictest criteria when it comes to serviceability. Now there are alternative lenders in the marketplace, whilst potentially post the 12 months interest-free period, they might be slightly more expensive. They will at least give you that potential buffer for the next 12 months. I mean, especially now we're going into a second lockdown, people's revenue will be decreasing, but there is still going to be costs coming in. So those sort of cash flow forecasts you might have done previously with K Johnson G might not now be relevant. So it's really important to have a look, understand exactly what your requirements are moving forward. If the bounce back loans that you potentially had to take just because you know CBILS was too slow, if it's not enough, CBILS can be used to refinance bounce back loans as well. You can get additional debt. Just the key figure here is you're allowed to borrow up to 25% of 2019 turnover. So I'd strongly recommend every business has a look at what that figure is, sees what they've currently got under either the bounce back loan or CBILS, and looks to see if you can actually increase the amount of funding you have in place. Because like I say, it is a win-win. If you simply do not need that liquidity, after 11 months and 30 days, you can repay it and you won't have it won't have cost the business a penny, but at least it would provide you with that bit of that safety buffer and security, just in case this lockdown lasts more than the 4 weeks it's meant to. Because we only have to look back to March, where we were told the initial lockdown was only going to be 3 or 4 weeks as well, and it ended up being nearly 4 months. So yeah, I'd just strongly recommend having a look at that marketplace. And like I say, speak to K Johnson G, have a look at some forecasting and see what it is that you could get from CBILS. It's a brilliant, unique product in the marketplace. So in terms of the changes, clearly this was announced very late in the day yesterday, so we did have to do a few amendments here to some slides. But yeah, CBILS, bounce back loans, the large CBILS, as well as the future fund, they've all now been extended again up until the 31st of January. So previously the deadline was the end of September. It then got moved to the end of November, and as of yesterday, it's now been moved to the end of January. Whether it gets moved again, I don't know, but it's a case of, in the lending landscape, these CBILS lenders are phenomenally busy. So I wouldn't delay again until potentially the last minute, until you might need it. I'd really try and use this opportunity and time frame to just go out there and see exactly what you can get. And yeah, it's like I say, it's a win-win. So in terms of the changes that we've seen with the bounce back loan schemes, the terms have now been increased up to 10 years. So you can repay over a longer period of time. The reason for that, the government was slightly worried that if they suddenly had this barrier after 5 years and the amortization period is quite short, it puts a lot of cash flow pressure onto businesses. So extending it over to 10 years just eases that initial sort of first sort of 6 to 12 months repayment. So it's not quite as cash flow intensive into the business as it might have been previously. You can have an interest only period. You can have repayment holidays, and they've also made it easier. Again, an announcement yesterday for the bounce back loan top up. So bounce back loans, same as CBILS, it's up to a maximum of 25% of 2019 turnover or 25% of forecast turnover, whichever you've used, depending on when the business was incorporated. You can now top up. So if you didn't quite take the maximum that you were allowed, you can quite easily go back to that original lender and ask for a top up. So that's, again, another change in the marketplace. In terms of CBILS, they intend to increase the term up to 10 years, but because it's a slightly more complex product, because the banks are underwriting it fully, they're still in negotiation in terms of how that is actually going to work. So that's still something that's going to be coming up in the marketplace. But yeah, some real key points there to have a look for and just understand.
Kip, can I just ask, as regards the extension to January and what you were seeing in November, recent week, should I say, with a planned November deadline, was there a real surge trying to hit the November deadline, or was it just, enough people had been doing it already? It was just sort of steady as you go.
No, absolutely not. It's the classic natural human instinct. People really did leave it to the last minute. We saw a huge surge towards that end of September deadline, mainly because the government left it really until the last minute to extend it. So there wasn't that sort of, August extension. It was done right towards the end of September. So people really weren't aware of it. So we had a huge influx. And what that does, it creates pressure on the actual lenders themselves. So instead of potentially being able to get the funding in place within sort of 5 to 7 working days, they were then looking at 2 to 3 weeks before they could start processing these applications. And clearly, if businesses need the cash injection sooner rather than later, you really don't want to leave it again until the next deadline, because I can assure you the same thing will happen again. Come January, we'll see a massive influx of new queries, and so will the lenders. It is slight human instinct, but I would really, really recommend just forecasting and just understanding it.
So the firms of accountants that will be dealing with a January deadline on this and a January deadline on personal tax returns are going to have a busy start to the new year, eh?
Yeah, absolutely. It was the same as the end of September, which I know is very busy for accountants as well. So I have to say they haven't timed these very well, have they? So to be fair, you guys as accountants have been at the forefront of virtually all of these new schemes. So you guys have done a brilliant job in supporting everyone. So
all right,
unfortunately, it's just
thanks for that.
Busy times ahead. So like I say again, if you've got any questions, anything on this at all, feel free to put it in the chat box, or we can message afterwards, whatever's easiest for anyone. So having a look then sort of beyond CBILS, clearly CBILS and bounce back loans are a phenomenal and a really, really important product. They're not always going to be suitable for everyone and not necessarily required for some types of finance. So we're just going to have a look at how the normal commercial lending landscape is at the moment. So at Capitalise, sort of like Rory spoke about, we can do and look at any single product or any single financial requirement that is needed within the business. So all products, we have access to the full range of lenders in the marketplace. So any requirement can be met through Capitalise. So the ones we're going to be focusing at the moment are going to be property finance, invoice finance, as well as sort of corporate finance, transactional deals. They're the most active in the marketplace. So if we have a look at the other products on here, working capital finance has now been virtually completely dominated by CBILS on bounce back loans, just purely because of how easy and accessible they have been to most businesses. I appreciate if you've been to a high street bank, you probably might not agree on that point, but in terms of the alternative lending space, I have to say they are very, very quick and efficient in terms of usually being able to get a decision out to the client directly. So that one has been sort of now just completely taken over by obviously these government schemes. If we have a look at another one, so trade finance, sort of supplier finance, that has been massively impacted by COVID and is quite difficult in this environment just because of obviously a lot of borders are shut, there's restrictions in supply chains, so that has been significantly affected. But again, we can offer that sort of support in the marketplace, but it will be under normal commercial trading terms. Then with asset finance, what we found is there was a lot of sort of patent built up demand for that during obviously the first initial lockdown. Manufacturers were shut, so there was a lot of sort of this build up of the requirements for these assets, and we did see a sudden surge in that as sort of businesses started reopening. Again, this lockdown is slightly different because manufacturers are allowed to reopen and they're allowed to stay open during this time period. Previously, they had to shut. So again, we shouldn't probably see as much of an impact in asset finance, but it's really important, obviously, that you can have a look at this under CBILS or under normal commercial terms, whatever is most suited to the business. But today, we're going to be focusing on sort of property finance, invoice finance, as well as transactional deals, which, like I say, are the most active products in the marketplace right now. So if we have a look at property now, just looking back on where this was in the last lockdown, clearly with valuations not being able to take place, a lot of the construction market was shut. It had a huge impact on the property market. It virtually stopped for a good 2 to 3 months. Again, this lockdown is different. While still restrictive, construction is allowed to continue. Valuations are allowed to continue. So the property market, whilst it will be a little rocky, there is going to be more uncertainty. So it's still going to be a little bit up in the air in terms of actually what the valuations come back on. The marketplace should remain pretty much fully active in terms of actually being able to do products, so do developments, continue with that sort of thing. So in terms of development finance, like I say, we still have a full suite of lenders in the marketplace. So what we have seen, generally speaking, is lenders just reduce their slight risk appetite. So they're looking for clients with probably a bit more experience than they might have necessarily had before. Not really looking for those ad hoc projects or the sort of vanity projects, as they like to call them, for properties over 1 million, unless it's in sort of prime London. And the sort of loan to gross development value and loan to GOS, which are key to the developments. Again, they've generally sort of reduced by between sort of 5 and 10% across most of the lenders, but they are still active, they are still open, and they are still sort of allowed to continue, obviously, with the construction market staying active. Similar sort of vein with bridging, although bridging is slightly different because it has been quite reliant on desktop valuations in the past as well. So it hasn't been as affected, probably the least affected product within property. So what bridging is it allows for real fast completions on property deals. So you can quite often complete within 5 to 7 working days. So a lot of these are used for potentially tenants of commercial units who potentially have the right to purchase from their lease, but they have to actually complete within, say, a 2 to 4 week time frame. A bridging loan to obviously secure that property, the same refinance on the commercial mortgage, is quite prevalent, as well as what we found recently with property development, in terms of obviously previously with the construction market having been closed down, a lot of development timescales were sort of now 3 to 6 months delayed. And clearly they'll have a set timescale of maturity within their original development finance. So what we have seen a lot of is a lot of people doing development exit bridges. So what that means is they'll refinance their development loan with a bridging lender to give themselves, say, an extra 6, 9 or 12 months in order to sell the properties at the market values in which they're looking to actually obtain it, to get the sort of margins that they originally thought they were going to get. So bridging has been quite active, and it's been used obviously to support those who have been affected in the marketplace. But it's a really good, unique product, which a lot of clients and people aren't fully aware of, because it's just not used at all within the high street. So it's only tends to be used within specialist lenders. So then if we have a look at the commercial mortgage lending landscape, this probably hasn't been affected greatly because it's a real vanilla product. Obviously, it's just a loan for you to buy your own trading premise or a secondary premise, and it is the most vanilla product, and it's still dominated by the high streets. Having spoken to the vast majority of the high street, they are still more than happy to provide that sort of debt financing up to the 70-75% that they were pre-COVID. The only caveat with that is that NatWest and Santander are still quite restricted on what they're willing to look at for new to bank clients. So if you already trade with them and already a main client, absolutely fine. But if you're new to bank, they're still slightly restricted. But we do have excellent relationships with Lloyds and Barclays, which are providing sort of phenomenal rates in these marketplaces. And we're actually seeing quite a few refinances come in. So potentially if you had a commercial mortgage at, say, 3.5%, 4%, you're able to now refinance quite regularly below the 3% mark. So it's, again, something to look at. Obviously, with interest rates now at 0.1% in terms of the Bank of England, there are some incredibly competitive rates out there for these types of products. Then moving on to sort of the buy-to-let commercial investment landscape. This, again, had a real impact during the first lockdown. We saw loan to values decrease from where they were previously, all the way up to 80% loan to value, down to 50, 60% at most. There was just real uncertainty. They were only using desktop valuations, and they just weren't willing to sort of lend out in a marketplace where they couldn't get that confidence in the valuations. We've seen that completely reverse all the way back up, and it's only taken 3-4 months since obviously restrictions were initially eased. Now lenders are going all the way back up to where they were previously. So we're very comfortable lending at 70, 75, and sometimes up to 80% on an interest only basis for these products. I will caveat that is mainly residential. Commercial investment is still slightly restricted just because it's a high risk product. So generally speaking, 65% loan to value is the maximum you'll get for a commercial investment, but the marketplace is still relatively open for that. Then if we have a look at Invoice Finance, it's a product which is probably a little bit misunderstood in the marketplace. A lot of clients and a lot of people still look at it as a product of last resort, or that a business is in financial trouble. For us, we see it as actually a really key product in moving out of sort of COVID and getting businesses back up to where they were before. So this is for B2B businesses who invoice clients. If you have been massively impacted by COVID and you're trading at, say, 20-25% of normal turnover, in order to trade back up to where you were pre-COVID, it absorbs a huge amount of working capital in the business. And if you've done your forecasting, cash flow forecast, it will show that within it. And what you find with this Invoice Finance product, it allows you to retrade and grow back up to where you were much faster, and ensures you are able to maintain cash and you don't overtrade. So we do think it's a really, really essential product in the marketplace. And again, you can utilize it within CBILS. So it can be free for the first 12 months if you're looking to use it maybe on a selective invoice discounting product, or potentially the full debtor book. We do think it's going to be a really, really key product just to help clients grow back up faster, and potentially those who are looking to say, I wouldn't say take advantage, but utilize where they are in the marketplace to really grow. It can be used as well within transactional deals, corporate finance, to release a lot of cash from a business in order to potentially go out, acquire others, or grow at a much faster rate just to gain that competitive advantage where we are in the marketplace. So again, slightly misunderstood product, which a lot of people think is very, very expensive. It's not what it used to be, and it can, if utilized correctly, be a really phenomenal product that can release a lot of cash from the business assets only to enable you to A, just retain cash in the business, or B, grow. So again, a really interesting product in the market, and something I'd recommend certainly looking into, especially now with it being free for 12 months, potentially under CBILS. Then lastly, so we'll look at corporate finance. So whilst obviously we don't provide at Capitalise the advisory, that'll be done at K Johnson G, we do provide the debt funding for clients, and we look at acquisitions. We've got lots on the go at the moment. We found that with CBILS and with a lot of liquidity being provided in the marketplace, there's a lot of opportunity out there for some businesses to be a bit opportunistic potentially in looking to sort of acquire other businesses, which might be sort of not trading as well in the current marketplace, or they've been able to obtain a significant amount of CBILS, and they've got a lot of cash, and they're able to now go ahead and potentially acquire a business that they've been looking at into the future. So we've seen a huge growth in this marketplace over the last few months, and it can be used for management buyouts, management buy-ins, acquisition, or what's known as growth lending. Growth lending is probably a less common transactional deal, but it's utilized within a business, just usually when you're sort of a venture capitalist or private equity backed initially, or you've got some seed or angel investment, and you're looking for that next stage of funding, which is, growth lending is cheaper than that sort of funding, and it enables you to continue that rapid growth in the marketplace to potentially gain a competitive edge, or whatever it might be. So like I say, this is also something we're seeing a great deal of in the marketplace come through. So really, really interesting time for this sort of M&A sector. So yeah, I think hopefully that's given you a good overview of sort of the lending landscape, the sort of timescales, what we've been over, in terms of the last sort of 6-7 months, just to put it into a bit of broad context. So the marketplace is open. Whilst we are going into lockdown, it is not the same as the first. We have a lot more confidence in terms of where we are. Lenders are a lot more confident. So I think that support that obviously businesses desperately need at this time should be available to you. And I'm sure K Johnson G will be able to support you in terms of exactly what that is and exactly what you need. So I think
just before
absolutely.
you move on, I would just say, as regards the marketplace, I just emphasise the point that we at K Johnson G, for example, like a lot of others, like to think that we can keep on top of the marketplace as we need to in order to provide advice on funding options. The reality of it over recent months and at the moment, and I'm sure it will continue to be the case, is that has become harder and harder and harder. And the big plus with our partnership with yourselves at Capitalise is definitely a level of knowledge as regards options and so on, which is a big step forward. I would just emphasise that point.
Yeah, thanks.
Sorry, Rory.
No worries. Over to you then, Roy, to talk about recovery.
Thanks, Kip. So Kip's talked about funding and the ways you can bring cash into your business to build resilience. I'm going to talk to you about recovery as an alternative way that you can get money into your business and build resilience. Kip, if you could go to the next slide, please. So late payments has always been an issue. Larger business will always try to extend their credit terms, which has put pressure on SMEs. But in fact, 42% of SMEs fear that late payments put their business's future at risk. 96% of SMEs regularly experience bad debts or other commercial disputes. Next slide, please, Kit. So the problem has always existed, but COVID has certainly exacerbated it. So COVID-19 has increased the time to pay. If we look at this graph, we can see that the percentage of unpaid invoices before the first lockdown hovered around 26%, whereas it peaked in May as we were in the middle of the first lockdown, around 46%. So I think it's going to be very important, the ability to ensure that clients pay on time and the ability to recover monies owed to your business is going to be very important in sort of riding out these turbulent times. Next slide, please, Kit. So why don't many SMEs pursue legal action? So I think there's three key reasons. One is time, especially right now. You've got lots of things to worry about. If somebody owes you £10,000, it might not be worth, the time input could put you off going through legal proceedings. But also, more importantly, the initial legal costs, especially if you're going up against a larger business, the defendant has a lot of protection, and actually those legal fees can be quite off-putting, especially with no guarantee of winning. And finally, I suppose there's a reputational risk. Supposing you built a relationship with a large company, they supply you with quite a lot of your income, you might be worried about rocking the boat or just generally creating a reputational risk for yourself when trying to recover the money that's rightly owed to you. Next slide, please, Kit. So Capitalise, what we've done to help solve this problem, and K Johnson G will be able to help you with this, is we've partnered with Escalate. They're an international law firm with a proven track record. They've unlocked £100 million worth of unpaid invoices. They're SRA regulated, but really importantly, they work on a no-win, no-fee basis. And when I say no-win, no-fee, many competitors of Escalate in this space will say that they're no-win, no-fee, but actually that's only until it goes to court. So you will still incur barristers' fees and so on. So Escalate, they're actually insured right up to the European High Court, meaning that you won't have to front those initial legal costs, and actually it will normally mean a quicker settlement because those larger businesses or whatever business it is, if they know that Escalate are engaged, they know that, you know, they can take it as high as they need to recover that invoice for you. Next slide, please, Kit. So I suppose, what does this look like in action? What type of debt can be recovered, and what scenarios might you want to speak to the team at K Johnson G about this? So Escalate can look to recover any invoice or contract above £1,000. This can be made up of multiple invoices that total £1,000. The reason why we've got the £1,000 benchmark is because there's lots of government support available for smaller claims. Escalate will actually look to recover any unpaid invoices dating back as far as 3 years in the past. So, you know, that it doesn't just have to be really recent. If you've had something in the past, we can revisit it now. I think also a key thing to mention is that you would go down this route, obviously, once you've tried to reach agreement with the contracted party and it's clear that they don't intend to pay. It says here, so the contracted party has the ability to pay. This is important. So, for example, if you know that somebody who owes you money has gone into liquidation or is no longer trading, especially if they've gone into liquidation a while ago, it's going to be very difficult to recover that money. So it's recommendable to obviously look down this route if you suspect that they can pay and they're just extending credit terms and being difficult. You know, all too often at the moment, people are using COVID as a simple excuse not to pay on time. And also, from what we've seen so far with Escalate, it's obviously going to be beneficial, you know, to look down this route if you've made the decision that you won't be working with that contracted party again in the future. It's a little bit more difficult, and you might want to reconsider looking at this option, you know, if you need to continue working with that company. And then final point is, so your business looking to recover unpaid invoices needs to be based in the UK, but the actual debtor can be outside the UK. So Escalate are insured up until the European High Court. So the debtor could be in Spain, it could be in Europe, it could really be anywhere, and Escalate will be able to look at this for you. Next slide, please, Kit. So that's an overview of recovery. I suppose it fits in quite nicely with funding. You know, being able to get paid on time and being able to get money into the business from debt that you might previously have written off is definitely going to be important, and it fits in quite nicely with Kip's funding piece as well. I'll hand over to Stephen now for any questions and the wrap up, but thanks all for listening.
Thanks, Rory. Just before we wrap things up, does anyone want to jump in, unmute themselves and ask extremely awkward questions or make extremely poignant points? If not, we will be wrapping up. So thank you all for joining us this morning. Thanks, Kip and Rory, for an excellent run through of both those areas. You know, it goes without saying, but I'm going to say it anyway, that the uncertainty that we face at the moment, for many reasons, not just the pandemic, mean that keeping on top of funding options and making sure we collect debts that can be collected, that maybe have been sort of written off and emotionally sort of dismissed in businesses, is of even more importance than it was, say, a year ago. So it's interesting that the ability to raise finances is much higher if it's done through firms of accountants like K Johnson G, and we're obviously very happy to help in that respect. So thank you all very much for taking part, and if there's anything that we can help with as a follow-up, just let us know and we'll feed into the guys at Capitalise as appropriate. Have a good day, everyone.
Thanks, everyone.
Thank you.